This is Jeffrey Cohen coming to you live from Highland Park, Illinois. And today we're going to talk about inflation, and I'm going to show you the life of a investment advisor who's looking at stock positions and probably going to look a lot like ADHD. But let's start with inflation. Pulled up a lot of data because I'm seeing discussion in the market that it's actually inflation that is causing a lot of the downturn. And so I'm not sure I buy it. I'm not sure I'm seeing rampant inflation. So first off, what do you think of our thumbnail? Hopefully you like it. We use Adobe Spark. We like it. It's good service. I'm always looking for pictures of inflation. Here's what I saw this morning. I saw a talking head talking about Eurozone inflation hits a high, 4.5%. That's the expectations, 4.9%. So when I see inflation like this, I get very nervous. In fact, Ray Dalio, Bridgewater Associates, I used to work for Bridgewater. Full disclosure, great organization, great company. They're talking about how cash is not a safe place to be right now because of inflation fears. And so let's take a look. So inflation's up 4.9% in Europe. Rome is burning. Oh my God, that was the worst pun ever. Rome is burning, but it is with inflation. So let's take a look in the U.S. What do we got? Jeffrey, what do you got with inflation? So let's take a look at some data. So we look at M1. And so just to remind everyone, inflation is based on the growth of money, growth of cash, money, deposits, things that can be quickly turned into money versus economic activity. So I usually look at that at gross domestic product, gross national product. You could look at it as retail sales, wholesale sales, number of transactions, right? And so you want to get some sense of activity, things to buy, work, things like that, versus cash, versus money to pay for it. And so the concept would be, if you remember your old economics classes, right? Robinson Crusoe is on an island and he has coconut tree, and he makes 2 coconuts a day. And there's $2. So how much are the coconuts, right? They're $1 a piece. $2, 2 coconuts, right? So if you said to Robinson Crusoe, hey, I just found $2 more in the sand. I'm using sand dollars, right? Now I got $4 and I got 2 coconuts. How much are the coconuts? Well, they're $2 a piece because I have $4 divided by 2 coconuts. Oh my God, they planted a new coconut tree. Now there's $4 and there's 4 coconuts. How much is a coconut? $1. You see how it works. It's not that complicated. Oh my God, this is like from grade school economic theory. So what I'm going to show you is going to be a little bit scary, right? First thing I'm showing you, by the way, while we're doing the work, I've got up Corvus top of book viewer from NASDAQ. This is a $15 a month data source. Love the data source. Okay. So we are long Corvus. God, we love Corvus. This, for us, it's our opinion. It's not investment advice, but I keep doing due diligence on Corvus. I keep liking the due diligence. I keep buying more. The stock keeps going down. I keep losing money, unrealized, of course, but wow. It's my largest position. It's a small cap nightmare, right? But I love it. I just did a spreadsheet. I got to show you. No, I didn't even do the spreadsheet. You know what I did? I did a spreadsheet in my head because it's so simple. So if you took Corvus and you took the cash, you know what? I put this on Twitter. If you guys don't know, this is ADHD kicking in. So I'm on Twitter, and I use Twitter to communicate with everyone else out there that might actually care about the things that I care about. And so I did some quick due diligence. Let's blow this thing up so you can read it. So first thing I did is I made a joke. And I said, wait, Corvus's chart pattern which you can see is just a steady decline. I said, I know this technical pattern. Eat your lima beans. They're good for you. It's a black hole, event horizon. Money goes in and never comes out. Or I'm just going to be sick, pull the car over, right? These are not good technical patterns, but that's what I was thinking of. But this is why stock investing is hard. The lower it goes, the better the relative valuation, and the tougher it is to hold. Ugh, I'm shivering. We added today. And then I talked about valuation. This is based on the 10Q that was just published. And you go into SEC Edgar search in Google, you pop it up, you see the current quarterly. Cash and marketable securities are $107.1 million. Some people just want to look at cash, right? Because what are the assets of a biotech, right? Office furniture. What are you going to do with office furniture? I don't know. Other assets are $12.5 million. All liabilities, all $42 million. So when you look at the value of the company is $77.6 million. There's 125.2 million shares as of the September 30 listing, which is like October. 88 cents a share. Oh, take a look. It's still 88 cents a share right now. It's a $110 million equity market cap. So if you subtract the equity market cap versus the book value, and which is mostly cash value, the drug pipeline costs you $32 million. So if you don't like lenabasum, and if you don't like all the other drugs they're working on, but you think they might have a chance of selling those drugs or developing something, you get the whole drug pipeline, the whole history of their drug pipeline, all of their goodwill, all of the work, the people, right, that do this. The fact that they have like a little bit of a, not a corner, but a specialization in the endocannabinoid system in the body, that's $32 million. So for $32 million, you get like a drug company, right? Now, they just recently reduced the cost of the company, which is very exciting to me because they just pushed their run rate out to 2024 before they have to raise money. By the way, Yuval Cohen, and we're not related, by the way. I'm not Yuval's relative, but if you need money, call me. Maybe I'll lend it to you. So don't issue more stock. I hate that. Just keep the stock where it is. Call me. Call me, Yuval. We got this. So I love Corvus. And Corvus is 88 cents. So whatever. I'm just going to hang on to it, right? This is a good discussion. This is when Yuval was talking to the Jefferies analyst. I want to say his name's Marty. Good guy. He asked a lot of great questions. Yuval got to really talk about it. So that's what I have up on the screen, 88 cents. My average cost is much higher. Oh boy. So let's get back to inflation. Jeffrey, stay focused. Inflation. So M1 since 2020 has gone through the roof. So let's be real here for a minute. M1 is liquid money. It's fast money. We had a little, we had about $4 trillion of fast money 2 years ago. Okay, so over 2 years. Now we're at 20. 4 to 20, we've added $16 trillion of money. I just want you to think about that for a minute. I'm going to get my pad of paper here. We went from 4 to 16. I'm sorry, 4 to 20. So we added $16 trillion plus, I'm going to type this somewhere here. Yeah, don't look at my notes. Here we go. So, fast money growth. We're going to do everything since 1/1/2020, right? Plus 16 trillion. Jeffrey, get to the point. Well, the point is, if money is growing this fast, right? What's going on? It has to go somewhere, right? So, and that's your pricing pressure. We're going to get there. So let's take a look at, do I have M2? We got M1. M1's great. Let's look at M2. So M2, January 1 of 2020, was 15.5. Where are we at now? We're 21.2. So 15.5, 21.2. So this is slightly less fast money growth. Since 1/1/2020 is it's 5.7 trillion. Okay, it's not quite as fast, but it's a pretty dramatic growth. And when we look at it in the short term, so if we were to really zoom on in, right, you'll see that it's been flattening, but it's still up, and it's still up roughly by the value of the taper, the quantitative easing. And so, all right, I got that. I got some growth there. So the other factor is velocity of money. So what happens is it's not just a growth of the money, but it's the speed of the money. It's M times V. You can't read that. Equals economic activity in whatever measure you want to have it. So let's see if we can make that bigger. Nice. We're going to get this for you. Any of you college students out there, it's probably going to help you in your economics class. If you're an investor, it's good to know these things. By the way, we're an investment advisor, registered Illinois, working on updating my brochure. It's a thankless job. Thankless job. Corvus, you moving? 88 cents? Do I hear 89 cents? Do I hear 90? Do I hear $1? Do I hear $2? You know, the other stock that I worry about, Hewlett Packard. So Hewlett Packard has earnings tonight. I love Hewlett Packard. I used to work for Hewlett Packard. I used to work for Siemens. I used to work for IBM. But Hewlett Packard always had a place in my heart because Hewlett Packard is an engineering-based company. It's run by engineers. It's run by salespeople and by engineers. What's interesting about that is they make really good stuff. They make the best stuff. Hewlett Packard makes great servers. They do. They make good communication equipment. They're really working hard to provide a value proposition to corporate clients. They also bought up the semiconductor business in the U.S. So, not semiconductor, a supercomputer business. So they directly compete with IBM. And their supercomputing business is doing great. By the way, we're into quantum computing, you know, Chicago Quantum. So we think about the supercomputing market. And Hewlett Packard's doing great. That's not a huge market money-wise, but it's a good market. So right now, HP is falling. Can you say rocks? Like falling like a rock, falling in the water? But Hewlett Packard always falls in the middle of the day. It's not a very good morning stock. You want to buy it, you know, if you're going to buy it low, you buy it as it drops in the morning and then it pops up later in the day. This thing's got a huge swing factor built into it. I like Hewlett Packard. We're long Hewlett Packard. We like, oh, Corvus, 89 cents. Thank you, by the way. Hopefully we're helping here. I'm not trading while we do this. I'm actually just making a video for you. So let's talk about this. So you see M2. M2's been growing. M1, crazy. So here's the funny part. I don't know about you, but do you have any money in your wallet? Think about how much money you have in your wallet. Okay. I got the same $11 that I've had a week ago. Did you know I went to a restaurant for the first time? They charged me a 69-cent fee to pay with a credit card. But I just don't use cash anymore. Even my debit card. I don't have a lot of cash in the debit card. Right? Oh, look. It's pretty light. And so my point is, we're not spending the cash. So why would you make this much cash? And they did it all by May. So what happened is they pumped the cash supply from like under 5 trillion. Actually, it's 4 trillion to 16 trillion. They put money in people's pockets, literally, money in the wallet. But why? I mean, fine. So we have it, right? So we don't starve to death. So we can buy our paper products. But still growing, though. Why is money still growing? I don't understand. I don't spend money. You don't spend money, is my guess. So let's take a look at the velocity of money. Oh, Jeff, now you get to the point. Thank you. The velocity of M1 is a story. It's a tale. You can make a movie out of this thing. It's a good story. In the 60s, it was like 4. So, and then in the 70s, it hit 5. And then in the 80s, oh my God, it hit 7.5. Money, the go-go years of the 80s, right? Things were exciting, right? Then they kind of flattened out to like 95, 6.2. And then, wow, 2000, people were like, hey, this was the dot-com boom. Right before 2000. Wow, it was great. Hit almost 9.5. And then during the crisis before the housing crisis, oh my God, it hit 10.7. So that meant, if you had $1, that dollar flew. It's got spent 10 times in a year. So where are we at now? I dare to say we're at 1. $1's $1. It moves 1 time in a year. 1.179, but effectively 1, right? So we created all this money and it just sits there. So inflation is driven by money. It's growing. But in this case, the decline of the velocity has soaked up a lot of that pressure. Because otherwise, I'd be telling you, fast money grew 16 trillion. My guess is the economy, we're going to get to that, didn't grow 16 trillion. So there should be like 100% inflation. But in fact, the velocity of money from January, so let's look at it. Let's type it, right? What is the velocity of money? And this is what I call fast money. M1. January 1st. Okay, it was 5.22. It's now let's call it 1.2. So it went from 5.2 to 1.2. So it's down 80%? Yeah, it's about 80%. So that's going to soak up a lot of fast money growth. Let me guess. The velocity of money less fast, or M2, it also dropped. Jeffrey, get to the point. Everyone tells me that. I'm not getting to the point. Velocity of M2 has also dropped like a rock. It's a little less of an exciting story, I got to tell you. The highlight, right, 2000 go-go years was like 2.1, 2.15. It hit 2.2, maybe 2. Where are we at, Jeffrey? How are we doing here? All right, January 1, it was 1.37 or 1.37, and it went to 1.1. 1.11. So 1.37 to 1.12 is a decline of 20.25 or about 20%. Down 20%. So effectively, the money supply grew. Roughly speaking, the money supply was like grew about 20%, down about 20% velocity. Grew, let's say, 4 times, down 80%. So you've got this velocity of money thing that is soaking up excess liquidity in the market. You may actually argue that the Federal Reserve saved our bacon, saved our lunch, saved us, saved our economy, saved the standard of living of the average person. Because had the velocity of money shrunk and money stopped moving, and then there's less money, you would have had a tightening. You wouldn't have money in your wallet, not because you didn't feel like it, but because you couldn't have it. You couldn't afford it. There was no money. You'd be selling your furniture to eat. You'd sell your jewelry to eat because there's no money. There's no cash. You wouldn't be buying stocks, go, go, go. You'd be selling your retirement accounts. So it's probably good the Fed did this. So this is one half of the equation. And one half of the equation says velocity of money and fast money growth kind of counter each other out. But at some point, you have to stop the growth of money. Now let's talk about economic activity. So real private domestic investment is investment in the United States. So the way they define it is, they're not defining it. This is billions of dollars invested in our economy. And so using the same model, Jeffrey, talk to me about flow of money. So we were seeing investment in our economy of $3.2 trillion a year, annual, seasonally adjusted annual. And now we're at 3.6. So really, investment into the United States, you're up 200 billion a year. So that's a proxy for economic activity because it's money coming in. So money coming in, or what I'll call gross private domestic investment. There's foreign investment, but I don't have it handy, right? But we're only like plus 0.2 trillion, which is not much. That's fine. But good to know, because maybe people were investing, and that would make economic activity go up. What else we got here? Oh, real gross domestic product. Let's take a look. Now, it's a beautiful story. The United States is an economy that just won't quit. Well, we have slowdowns. We do. But they tend not to take very long to come back. You know, to be honest with you, going back to the 50s, to the 40s, our economy is very resilient. But you can see right around 2008, 2009, the decline was a little steeper. And right there, the COVID decline, the pandemic decline was downright spicy. It was a V shape. It was spicy. Look at that. That's awful. Let's take a look at January. We were at 18.9. Let's call it 19.0 GDP. Now we're at 19.46. You know, maybe I'll keep it that way. So 18.95, 19. Wait a minute. Why is my 9.5? Oh yeah, we're up 500 million, 500 billion. So real GDP growth plus 0.5 trillion. Not a lot. See, this is the thing. You'd expect if activity was up, you'd need the money to be up. So really what we're looking at is that velocity of money and the growth of money have to even out. And in fact, look at that growth rate. Look at how it slowed down. You know, in a quarter, the U.S. economy grew 1937, 1947. So we're growing 100. So this isn't relevant. This is relevant. So this is last quarter GDP growth, 0.1 trillion. By the way, that is not a lot. How about M2? How did M2 grow in the last quarter? $21.11, $21.26. So that grew 150. So money grew faster. Let's see if it's true with M1. 1909, 1988, 1989, 2008. No, that grew about 80. 90. Call it 90. So That's effectively 0.1. So what I'm seeing here is that the Fed is, to a pretty fine level, managing real GDP growth with monetary growth to within 50 billion in a quarter. That is nothing in a $20 trillion economy. And so I feel like we got a handle on it. We're not seeing the types of growth in economic activity or investment that should be driving inflation. So now let's take a look at the real GDP, the nowcast. Love that, nowcast. So this is the to the minute, to the day forecast that the Federal Reserve has of what the GDP growth will be this quarter. And it gets revised a lot. So they're suggesting that we're growing at a 3.77% GDP growth rate. So what they're saying is that, so the nowcast GDP growth rate Q4 2021 is 3.77% annual. So that, how much money we got? If we got $21 trillion times 3.77, that's about 7.5, maybe 7.6. Let's call it 7.6. No. 0.76 trillion in what I'll call capacity to grow M2 to accommodate economic growth. So now let's do the bad math here, right? So the quantitative easing was 12 months times 0.12 trillion per month was 1.44 trillion in expected future M2 growth. This is your problem. Was that expectation of future economic growth is 0.76 trillion. Expectation of future monetary growth 1.44 trillion. And so inflation should be, let's call it 0.8 trillion divided by 20 trillion. What's the size of our GDP, Jeffrey? How big's our GDP? Tell me. How big? 19 and a half. Thought it was bigger. Let's get the handy calculator out and let's figure this out. How much inflation are we expecting to have next year? So what is the inflation expectation? .1%, and this is why the Fed is tapering. So, what's driving inflation? And Jeff, you're telling me the numbers don't lie, big picture numbers. So where is the inflation? Show me the inflation, Jeffrey. I'm going to show it to you. You're going to love it. Where am I going to find it? By the way, you get to see my portfolio. It's not great today. Satsuma, Corvus, Hewlett-Packard, American Shared Hospital Services, and Verizon, plus a bunch of calls. But the reason I'm here is for oil. Let's take a look at oil, front month futures. And let's take a look full screen. Where's oil? And let's go back. Shoot, let's go back 5 years. So you can see oil has been running at about $50 a barrel. My guess is if I were to draw a regression line, it'd be about $50. But let's try it. Start 5 years ago. Nope, it's higher. It's higher. It's there it is. It's between 50 and 58. 53 and 50. So call it 55. Average price of oil, $55 in the last 5 years. But we went up to 80. And if you look from 2020, we were at 59. We dropped to 17. We shot all the way back up. And so when oil was $80 a barrel, of course that just kills the market. It kills your ability to go to the gas station and have money left over. I read studies, many studies about this, right? So oil normally at $55 a barrel and it hits 80. So let's talk about it. Oil, 5-year average, $55 a barrel. Front month futures contract. I think this is New York Mercantile. It is. Okay, so it hits 80. So what happens when it hits 80? That means price at the pump, let's say, goes up double, 2x. If the average American $50 gallons a month times, let's say it went up $2, is $100 a month tax on every American. I think this is your inflation, guys. And by the way, oil hits $55 a barrel again, which it looks like it may. It's on that trajectory real fast. Look at those real fast drops. Look at those real fast drops, by the way. I'm sorry, this wasn't my idea, but look at that trajectory right there. Those are fast drops. What is going on, right? Like, look at that. These are fast trajectory drops. And so this is how oil drops. It's not gentle. So if you see oil cross that $55 a barrel mark, you are going to see moderation in the inflation fears globally. So I'm excited about that. But on the other hand, you might not see that. You might actually see oil go back up to 100, and then life gets crazy. All right, I want to thank you for listening, right? This is our talk of inflation. Net. If oil returns to $55 a barrel, New York Merc, I think inflation concerns will return to normal. It's interesting, right? If the Federal Reserve Bank tapers out QE to 0, you see inflation concerns drop. 4% inflation just due to quantitative easing. That's it. Folks, wrap it up. So what else do you want to know? Well, first off, Corvus is up a few cents, which is nice. HP's down a few cents. Is there anything else worth looking at here in terms of the markets? So, you know what? We'll take a minute. We'll take a look at FinViz. I like that site. I always talk about it. Where are we at with the market today? Well, it's pretty red. What do we got? R.R. Donnelley. What's going on with R.R. Donnelley? I've been watching that. That's been a high volatility, low expected return stock for a year. I think I noticed it at 775. It's at 1050, so it's up. It's a crazy stock. They must be trying to buy or sell themselves. Something crazy. See, the new stocks aren't moving. Let's take a look at this. So, telecom is down like crazy. Look at that. So I wonder, why is telecom down? People are going to be using their phones, their home internet. Of course they are. But all communication services are down, right? So it's like we're down on communications. We're up. I mean, Tesla's up, and Apple and Pfizer, but not a lot. Let's take a look at the bubble chart. Moderna's down 5%. Never heard of that. Gap is down. Gap has a lot of weakness. And there you have it. Now we're going to start due diligence on a new stock. The gap is down. Why is the gap down? Institutional ownership is 58%. That provides a nice buffer. Price to book at 2.23 seems pretty high for a retailer. Cash per share is $7. So of that 16, $7 is cash. It's just interesting, right? So we take a look at the Jefferies has a hold at $23. Downgrade JP Morgan to $22. It's not a popular stock right now, right? So of course for us, goes on our radar. We love downtrodden stocks. So we'll keep watching. We actually have it on our list to watch. So again, thanks so much for listening. We talked about inflation. We watched Corvus. I mean, it's so sleepy. We watched Hewlett Packard. There's really nothing going on in the market right now. And some other stocks that we own: American Shared Hospital Services, Satsuma, Verizon. Just kind of a sleepy day in the markets today. And you take care now. Thanks for watching. Bye-bye.